Hello, all of you. I hope you all are doing good. And today we are going to cover account standard 2, that is valuation of inventory. As you can see here, we are going to cover introduction, definition of inventories, measurement of inventories, comparison of cost and net realizable value, special cases, joint product and byproduct, waste or scrap, cost formula and disclosure and classification. And after this, I am to cover the question from that AS top 100 question. In that, we are going to cover today the accounting standard 2 questions. So, we'll start with introduction. First of all, why there's a need to issue this accounting standard? Because CNC issue one by one accounting standard. So when they issued these accounting standard in past, why they have issued this? Because if suppose this is my trading and profit and loss account and this is my balance sheet. Okay, now understand this one. If there is no accounting standard, how people can do the manipulation? This is my profit and loss account. I write it down here, closing stock. Okay. So this valuation is very important of closing stock. If I am not doing the valuation properly, my profit is going to be affected here. How it can be possible? Suppose if I increase the value of closing stock, my net profit will increase. If I reduce the value of closing stock, my net profit will go down. At the same time, in balance sheet, under current asset, we write it down closing stock, correct? So that current asset value will also get fluctuate. Okay, so it is important that there should be a proper valuation of inventory. This accounting will talk about how to do the valuation of inventory. So let's start that here. As I told you that in the closing stock, we write it down on credit side of trading P&L account. If we are not doing the valuation correctly, so my net profit is going to be affected here. If we show more closing stock, my profit will increase. If we reduce closing stock, the profit will also get reduced. So it is important to do proper valuation of closing stock. So accounting standard 2 talks about the AS to provide a guidance on valuation of inventory in financial statements. Now, what do you mean by closing stock? It is important to understand what do you mean by closing stock. So they say inventories here as asset held for. Now understand this point. They say inventories are what? Asset which are held for sale in the ordinary course of business. Okay, so for I'm using this pencil. Is it inventory for me? No, because I this is asset I held for, but not for sale in the ordinary course of business. So I'm not this. I use this pencil, but I'm not. I held it, but not to sell in the ordinary course of business. This is not my nature of business. So this is not inventory for me, but from the shop where I purchased this for that shopkeeper, he is dealing in these pencil. So he held these pencil to sell in the ordinary course of business. So for him, it is what? Inventory. So they say sale in the ordinary course of business, that might be finished goods or stock in trade. What is the difference between finished goods and stock in trade? To understand this one, first of all, when we talk about inventories, okay, when we talk about inventories, it might be happen businessman is in the business of manufacturing. So when we talk about manufacturing, that here three types of inventories might be happen that here. Okay, so three types of inventory I will discuss with you one by one. That is finished goods, WIP and raw material. Other than manufacturing, okay, other than manufacturing, so there is only one type of stock, that is stock in trade. So what is the difference between, okay, what is the difference between that here now is between the stock in trade and finished good. Finished good is basically we have manufactured, that is stock in trade. We are not in the business of manufacturing. We purchase good and we will sell it at a higher value. Okay, so they say we held for sale in the ordinary course of business. Finished goods, that is going to happen in case of a manufacturing company, or stock in trade, we purchase it and we sell it at a higher value, or in the process of production for such sale. It means it is in the production. Okay, it is in the production. What we call them? WIP, work in progress. So at the end of the year, when we do the valuation of closing stock, generally we do at the end of the year. When we do the valuation of closing stock, there will be a finished goods, WIP in case of a manufacturing company, or for consumption in the production of goods or services for sale. To make it simple, that is a raw material that we are going to use it for the purpose of what? Production of goods that here, or if you're providing the services, in that service, if you're using that raw material. For example, if we talk about from the doctor's point of view, the doctor is going to use some medicines or injection that year to provide the services that year. So if it is held at the end of the year, that is asset for him because he is going to use it next year. Okay. So they say, what is this inventory? Inventory as asset held for sale in the ordinary course of business. We call them finished goods, or in the process of production of for sale, WIP. It means work in progress, which is not in the form of raw material and which is not in the form of finished good, which is in between. It is in the process that year. Okay, we are manufacturing the finished goods that year. Okay, so in the process we call them WIP, and for the consumption, it means that we are to use it in the consumption for the production of what goods or services that year. Now that is, these three inventories is going to come in case of what? Manufacturing company. If it is not a manufacturing company, then it's other than manufacturing. They have only one type of stock and we call them stock in trade. The one note is given here. Don't worry about this note because this note is going to be discussed in detail when I will cover accounting standard 10, that is property, plant and equipment. They say if spare parts, example nut, bolt, screw, now standby equipment items which is kept as a backup in the servicing equipment like the loose tool, if they do not meet the definition of PPE. What is PPE? Property, plant and equipment. If they do not meet the definition of PPE, then these are considered as what? Inventory. To make it simple, if the spare parts, standby equipment and servicing equipment, if they meet the definition of PP, then they call it PP. Otherwise, they will come under the accounting standard 2, that is inventory. Now the question arises, sir, what do you mean by these? When they meet the definition of PP, we have not yet covered accounting standard 10, that is property, plant and equipment. This point will come there also. So when you will come to know about the definition of PP, you will understand this point. Time being, understand that here, if these three items, spare parts, standby equipment and servicing equipment, if they meet the definition of PP, then we are going to call it as PP. They will book under accounting standard 10. If they don't meet the definition of PP, then they will come here on accounting standard 2, that is valuation of inventory. Okay. Now, under the definition we have discussed, three things is going to come: finished goods or stock in trade, WIP and the raw material. Okay. Now, there are certain things which exclude certain items. What? First, WIP in construction contract, because which is covered by accounting standard 7, while AS2 applies to inventory held for use like cement at the construction site. Now please understand, this construction is going on. This is a WIP. So who is going to cover to this construction? Accounting standard 7. Okay. If there are certain goods which we are going to use it for that construction that here, for example, cement we have. Okay. This is going to cover under accounting standard 2. Otherwise, WIP in construction contract, where it will cover? It will cover in accounting standard 7. Now, WIP in case of what? Service provider. So, while AS2 applies to inventory not consumed at the end of the year, like fuel and stores in case of a shipping company. They are basically telling us, I will give you an example of the shipping company. All these are examples mentioned in IC study material as well. Okay. So, what happened that here? In case of a WIP in service provider that here, so they gave an example. Suppose they ship from Chennai to Dubai that year. Please understand that. Chennai to Dubai. Now we are consuming a fuel from, when the ship is going on from Chennai to Dubai that year. This fuel will be the WIP in case of a service provider. So you are using it while you are providing the services. So we are providing services and we are consuming that fuel here. So it will not cover here under accounting standard 2. So what will cover? The fuel that we have here that we have not yet used. Okay. So it is going to cover, it is my inventory because I am to use this fuel to provide the services. You got the point that here we are to use this fuel to provide the services later on. So this is my inventory. But these here, this fuel you are consuming while you are providing the services that here, that is WIP in case of service provider. And this WIP in case of service provider and WIP in case of construction contract not cover in accounting standard 2. Okay, what cover in under accounting standard 2? In case of a construction contract, the inventory held for use like the cement, okay, that is going to cover under accounting standard 2. In case of a service industry, certain item that you are going to use it to provide the services in future, like here the fuel that will use it for this ship that this fuel is going to cover here, not this WIP part. Now, third point is that here, shares or debenture which is held as stock in trade. What does it mean, stock in trade? It means that I am dealing in the business of purchasing and selling of shares or debenture. So here accounting standard 2 say, don't come here. The inventory, don't come here. So where he will go? Now he goes to AS13. I will cover AS13 as well. Okay, it goes to AS13. When he goes to AS13, AS13 also say, oh, shares or debenture, your stock in trade, don't come here. Okay. So AS13 also deny them. AS2 also deny them. So where they go? So it is a general practice in India generally for shares and debenture which are held as stock in trade. Generally they do the valuation at cost or fair value. Anyways, but under AS2, shares or debenture held as stock in trade, they are also not going to cover here. Now, the last point, producer of what? Producer of inventory of what? Livestock. Example, a dairy farmer owns 50 cows. That is, so those livestock is not going to cover here. Then agricultural, okay, agriculture, a wheat farmer harvests 1000 kg of wheat. That is also not cover here, that inventory. Forest product, like the timber company cuts down the trees that is forest product, that will also not cover under accounting standard 2. And mineral resource, like the mineral company, the extract was iron ore or the coal from what? Mines that here. So that will also not cover here. So they say producer inventories of what? Livestock, agricultural, forest product and mineral resources that here are, that is a general practice. They do the valuation generally at NRV, but they are not going to cover under accounting standard 2. A very important thing is that, you know, when we talk about the producer of the agriculture product, producer, okay, not the trader. Please understand this point. This is a wheat farmer. If you go to the mall that here, if in your, suppose in your city, if you go to mall that here, you see there are vegetables there in that mall also. So the AS2 is applicable to them because that is they say producer, that owner of that particular mall, he is the trader. He is not a producer of agriculture product. The farmer, then they have these agriculture product. AS2 is not applicable to them. Is not applicable. He is producer. When you go to the mall or any vegetable shop, they are not producer, that trader that is. Okay, so AS2 is applicable to them, not to producer. Okay. Now, very important thing is that here. Now important point start here. It says that here now, when we talk about the measurement that is, so accounting standard 2 says that here, when we talk about these closing stock, these are very beautiful. Listen carefully to me. Each and every word, listen carefully. When we talk about this closing stock that here, they say this closing stock should be, the valuation should be done at cost or NRV, whichever is lower. So when it says that here, this closing stock valuation should be done at cost or NRV, whichever is lower. I will tell you why lower. Why lower? Why they use the word lower only? Okay, I will tell you that here. Okay. Now what happened that here now? They say closing stock should be done at cost or NRV, whichever is lower. So it means we have to understand what do we mean by cost, what do we mean by NRV, because they say cost or NRV, whichever is lower. So I will explain you what do you mean by cost. I will explain you what do you mean by NRV. But before that here, I want to tell you the logic. Even though it's a revision, the video, still I will try to convey the message to you that why lower on. You know, there is an accounting, basics of accounting. There is a concept called conservatism. What conservatism approach says that here? It says we have to book the expected losses, not gain. Expected losses. This conservatism approach says we have to book the expected losses that. Okay, that's why we create a provision for bad debt and all that. Okay. So, for example, if I say the cost is, let's say the 10,000 and NRV is 8,000. I will explain you what is the NRV, but net realizable. If you sell in the market, how much will net amount will get? Suppose that is coming 8,000. So my cost, I purchase the product at 10,000, the cost to be is 10,000 and I'm expecting that I'm to sell it. Maybe for any, generally we don't sell below the cost, we sell at higher the cost. But suppose that I'm selling below the cost, might be any reason, out of fashion or damaged goods, whatever. So NRV, suppose example 8,000. So in the product that I have purchased, the cost to me is 10,000. I am to sell it that here at 8,000. It means I'm to sell it at loss. The cost is 10. I'm selling it. I'm expecting to sell it 8 in future. So I will get loss. So here they say, instead of recording 10,000, record 8,000. You know what will the impact here? If you reduce the here, the closing stock from 10 to 8, your profit will also go down by 2000. Go down because you reduce from 10 to 8, so your profit will also go down by 2000. So these conservatism approach says this is not actual which happens today, which is expecting to happen in future. So they say it is going to happen in future. Book it now. Why? That's why they use the word lower. They don't say book it now, but they are saying basically to book it now by telling us to book the lower. So cost or NRV, whichever is lower. If suppose here the NRV is 8, I record 8. So if I reduce from 10 to 8, here my profit will also go down by 2. This is logic behind this. Okay, now we'll understand that here. What do you mean by the cost here? Quickly, okay. So under the cost that here, they say here, the cost, what it covers that here now? The cost of purchase, that is the purchase price, plus the duties and taxes, non-recoverable. Non-recoverable on which we are not going to claim the input VAT. Okay. Or GST. Okay. Any tax which we are going to recoverable from the government or we are going to claim as the input. Okay. Now here, plus the expenses which are directly attributable to the acquisition, like the freight we have paid. Okay. Now, if discount, if any, that should be deducted. Now the conversion cost, it might be happen, I'm doing the manufacturing. So we purchase raw material, we are going to convert it. So labor cost, material cost, production overhead, refer note number 1. I will come to this production overhead. Okay. I will come to that. If refer note number, I will come to note number 1. Okay. Or any other cost that we have incurred to bringing the inventories to their present location and condition. Any expense that we have incurred to bring that particular inventory to their present location and the condition that is. Okay. Then they say, now what happened in the examination? We have to calculate cost per unit. So this will be the total cost. You will write it down the total cost here and you have to divide it by the total number of units that you have manufactured or you have purchased minus the normal loss unit if any. Because the normal loss amount is going to be bear by the remaining quantity. Okay, we don't record normal loss in books of account. They say total unit minus normal loss unit if any, then total cost divided by this number of units. So you will find cost per unit. If they tell us the value of the closing stock, cost of the closing stock. So I will say closing stock quantity multiplied by the cost per unit. You will get the amount of closing stock. They say, okay, tell us the material consumed or COGS, cost of goods sold. I will say material consumed or cost of goods sold unit. I will multiply with the cost per unit. Okay. They say calculate abnormal loss. They ask certain abnormal loss. Okay. So I will say abnormal loss unit. I will multiply cost per unit. How we find it cost per unit? To this formula. What is total cost? These three items that is. Okay. Now, NRV. Okay, before I come to NRV, before I come to NRV, that is one point that is related to production overheads. We also call factory overheads. So please understand that through this example, what they're telling us. Okay, please one by one listen carefully. That there is a logic behind it. I will also explain you. Just listen me carefully. Okay. Now what happened that here now? These the factory overheads. So now overheads might be variable, or it might be fixed. How to allocate that? Okay. They say there might be three possibilities. Variable overhead, first of all, variable overhead is simple at production cost or actual production cost. But when it's come to fixed overhead, I have to see normal capacity. When actual production is equal to or less than normal capacity, we have to do the valuation at normal capacity. If actual production is higher than the normal capacity, we have to do the allocation at actual production. So students generally get confused here. Now listen me carefully through this example. If I say that here now first, my actual production is equal to the normal production. My actual production is equal to, I will tell the logic also. Okay, it might take 4-5 minutes, but you will understand the logic here. Listen carefully. Okay, my intention that each and every point you have to understand, even though it's a revision video. Okay, if I say actual production is equal to normal production, equal. Example, if I say actual production is 1000 units. And normal capacity is also, normal production is also 1000 units. So how to do the valuation? Valuation will be done at normal capacity. This first. Okay, when actual production is equal, I will do at the normal capacity. So how we are going to calculate the cost per unit here in this case? So I will say total fixed overheads divided by normal production capacity. That will come the cost per unit for the fixed overhead recovery, and I will multiply by with the whatever closing stock I have. If my actual production here, actual production is less than normal, the production that here. Okay, for example, I have actual production of 800 units and the normal production is what? 1000. In these case also they tell us to allocate on the normal capacity basis. Same formula, fixed overheads divided by normal production capacity. But you know what happened that when I say my actual production is more than normal production that here, for example, actual production is 1200 units and normal production is 1000 units only. So this actual production is more than the normal production. In that case, this is the difference. Generally, IC don't ask this tricky point, but you have to understand. They say actual is going to, they may ask, but okay, we cannot trust them. They may ask anytime. If my actual production is more than the normal production, so they say in that case, we have to allocate a fixed overhead on the basis of actual. So what is the formula here? The fixed overhead divided by actual production. Let me tell you the logic quickly. Okay, now please understand this one. If I say you that here now, okay, where should I write that here? Okay, now listen carefully. Okay, if I say that here now, my actual production, if I am saying how much is actual production, I have 1200 units and the normal capacity is how much here? That is 1000. Okay, so if I say total fixed overheads, okay, if I say that here now, total fixed overheads, that just give me a minute, let me change the color here. Okay, total fixed overheads 120,000. Okay, fixed overheads. If I divided by that here now with the 1000 only, 1000 is the normal capacity. I'm telling you the logic that here why we are doing the actual. Suppose suppose I divide by 1000, how much will come cost per unit? That will come here 120. Do you agree? Yes. Now in my closing stock, suppose I have done the production of 1200 and that 1200 is still in the stock. Assume that to make it simple for you, there is no sale. Still 1200 is in stock. So if I multiply by with 1200, so I will say that here now 120 divided by 1200 is coming 144,000. How it can be possible? You are allocating fixed overheads of 120,000 and you are allocating 144,000. How can we allocate more than the expenses that we have incurred? We have incurred a fixed overhead, suppose 120,000 that here, and the actual production is 1000 that here. Actual production is 1200 and the normal is what? 1000. If I distribute on the normal basis here, so here what is going to happen? Normal is coming 1000 units, right? Divided by 1000, 120 per unit. And how much we have in closing stock? We have done the production of 1200. I will multiply by with 1200 in my closing stock. I am adding the fixed overhead, the 144,000, which is actually I have incurred 120. That is logically incorrect that here. So that's why they say it is not allowed. What should we do? Let me tell you that here. They say use the normal production here. So in that case, 120,000 is the total fixed overhead divided by actual production is how much? 1200. So here how much it will come that here now? It will come 120,000 divided by that here 1200. It will come how much? 100. It will come correct 100. How much units we have in closing stock? The actual production that we have done. How much production we have done? How much? The 1200. So I will multiply by 1200 units, which is in my closing stock. So 100 multiplied by 1200, that will come 120. So I'm allocating 120 and actual fixed overhead is also 120. That's why they say if an actual production is more than the normal production, in that case we have to divide it by actual production to find it out the cost per unit to allocate the fixed overhead. Otherwise the normal capacity, there is no problem in that. This is the logic behind this. Okay. Now, okay, let me go here. Okay, now we discuss about what here? The cost here. Okay, now let me talk about, because we are doing the valuation cost of NRV, whichever is what lower. Very interesting that here. Okay, now they say here, what is NRV in case of, because we have three types of goods: finished goods, WIP, and what? Raw material. So dear student, what is this finished goods? They say expected sale value. If I sell it in the market today, what is the sale value? So they say expected sale value minus expected cost to make the sale, like the commission. When we do a sale, we have to give the commission. So how much we'll get net in hand? That is the net realizable value. So they say expected sale value minus estimated cost to make the sale. Example, commission. So expected sale value minus commission. Okay, I'll just give an example. What is this? What NRV in case of a WIP? One more thing that here, it is difficult to find it out that here. I am talking about WIP. This is finished goods. So here to find it out, the NRV of WIP is quite difficult. Why? Because I cannot say what is the expected sale value of WIP. Are we going to sell the WIP in the market? No. And it is difficult to find it out the value of WIP, NRV of the WIP in the market, because we are not going to sell them. Okay, nobody is going to purchase this and the product which is in the WIP stage. That is okay. So how to find it out that here NRV? In that case, it says expected sale value of finished goods. We can find the expected sale value of finished goods. Correct. Minus estimated cost to make sales. Estimated cost to make the sale. Same like a NRV of finished good. But one more thing will come that here now. What is that thing? They say here is the estimated cost of completion of WIP to finished goods. To make it simple, first we have to calculate NRV of what? Finished good. Simple. NRV of finished good, expected sale value of finished good minus estimated cost to make the sale. Okay. We find it out the NRV of finished good, but one more additional point will come here. That is estimated cost of completion of WIP to finished good. It means whatever cost I am going to incur from WIP to finished good stage, which I am expecting that I am going to incur from WIP to finished good stage, that also have to be incurred. So we find it out the NRV of finished good. How we find it NRV of finished good? Expected sale value of finished goods minus that here now the expected the sale value of the finished good minus cost to make the sale, and here minus will minus one more thing that here now the estimated cost of expenses that is from WIP to finished good stage. That is, you got the point. We find it the NRV of what? WIP. But when it's come to the raw material, we don't take the expected sale value because we are not going to sell the raw material in the market. So they say replacement cost means if we purchase a similar raw material in the market, how much it will cost us, including the cost of completion the purchase, like anything that we've incurred to purchase that raw material that here. Okay, additional cost that also we have to add that. Okay, these are the NRV for finished goods, WIP and raw material. But remember that here, very important point, that is the point number 2. Okay, now listen carefully. This is the most important that here. Okay, to make it simple that here, I have created situation and treatment in my rapid gist book. I have already written the example that it will help you to understand the concept here. Okay, now listen carefully. It says that here now, if we are discussing here replacement cost that here for the raw material we're talking about. Okay, raw material discussion it is that here. You can see that the raw material here. Okay. We're talking about the raw material. What it says, now listen carefully that here. They say if replacement cost is NRV of raw material, okay? If more than or equal to the cost of raw material, then valuation should be done at cost. Very simple. If I say, if my NRV is 12, okay, my NRV is 12 and cost is 10. Listen carefully. If NRV is 12 that here now, and cost is how much here? Is 10. So obviously lower of the cost on NRV, lower is 10 here. No problem in that. We are going to take the lower. They say, if NRV is more than or equal to, I can tell you the logic also. What is the logic behind this point number 2? Very interesting point. I will tell you logic. Don't worry. This here, the raw material, if their NRV of the raw material is equal to or more than the cost of the raw material, valuation should be done at cost because the cost is lower than the NRV. No problem. Just compare the NRV or cost. Lower is cost. No problem. Recorded the cost. Now, interesting point. If the replacement cost means the NRV of raw material is less than the cost of material, now the problem will arise. Okay, you say what is the problem? Let me tell you what. This is two situations. If finished goods are expected to be sold at more than equal to or more than the cost, then we have to do the valuation at cost. If finished goods are expected to be sold at less than the cost, then we have to do at NRV. Let me tell you the logic here. Now please listen me carefully. Very important next 3-4 minutes. Suppose this is my raw material. See here. This is my raw material. Now what is the cost? NRV is that 8. Suppose 8. And cost is 10. You will say, sir, here the NRV is lower than the cost. Do the valuation at cost. I agree with you. Do the valuation at what? Yes, sir. NRV is it and the cost is 10. The NRV is lower than the cost. Do the valuation at what? NRV. I agree with you. We are going to do the valuation NRV. But the one twist will come. Now they say, wait. If your NRV is less than the cost, wait for a minute. They say, please cross-check the finished goods cost on NRV. I say, why? They say, go to finished good. Okay, no problem. Because here my NRV is less than the cost. So I have to record it NRV logically, but they say wait, one exception is there. So I go to finished good. What is the NRV of the finished goods? 20 suppose. What is the cost of the finished goods here? What is the, just 1 minute. What is the cost of the finished goods that here? Just give me a minute. Okay, let me write it down here. The cost here. Okay. What is the cost of the finished goods here? 15. So what is going to happen that here now? They say in that case here, we have to record at what here? Here my NRV is 20, here cost is 15. So I am to sell my finished goods more than the total cost. Total cost is going to come out of the finished goods 15 and the NRV of the finished good expecting is 20. So my finished good, when I will sell finished good, it will be more than the cost. It will not be at loss. Okay. So here they say in that situation here, even though your cost is more than, logically we do cost or NRV, whichever is lower. So they say, no. Here, even though your NRV is lower than the cost, still you have to do the valuation at cost only. I will tell you the logic that. Don't worry. I will tell you the logic. Listen me carefully. They say, first, what is the point? NRV of raw material is less than what? The cost of raw material. Yes, NRV of raw material is less than the cost of the raw material. Correct. Then, if finished goods are expected to be sold at or more than the cost. So it is finished good expected to be sell at more than the cost, because the cost is 15. It is going to be sell at more than the cost. Here in that case, we have to do the valuation of raw material at the cost. Let me tell you the logic. You say, why sir, here the NRV is lower than the cost, still you are doing the valuation at cost? Yes, the reason is that here, what is the logic when in this say low? I told you that here is the concept of the conservatism approach that here. So when we do the conservatism approach, what happened in that case here? In case of a conservative, expected losses we have to book it now. Even though my NRV is lower than the cost, but it will not be a loss, because when this raw material is going to use in the finished goods we are not going to sell at loss. That will sell at what? Profit. So in future there is no loss. That finished goods in which this raw material is going to use, that finished good will be sell at a profit. So there will be no loss. So recorded cost, no problem. This is the logic behind it. Okay. If the finished goods are expected to be sold at what? Lower than the cost. Okay. Let's take again figure. My NRV is 8, cost is 10. So lower is 8, but wait, exception, I will go to the finished good. In case of finished good, NRV is 12. And how much is the cost that here? How much is the cost that NRV is how much here? 12. And the cost is 50. It means that here, finished good is also going to be sell at what? Is also going to sell at what? A loss. NRV is 12 and the cost is 15. It means the finished good will also be sell at what? Loss. So what is going to happen that here now? They say, okay, so here, obviously my NRV is lower than the cost, recorded 8 only, because this loss is going to happen because finished good will also be sold at loss. Okay, so loss is going to happen, record it now. So they say cost or NRV, whichever is lower. That's why. So keep this exception, be careful that here, we'll solve the question, this point will come there. Very important table this is. Okay. So whatever I have highlighted this red color, that this is the amount at which you have to do the valuation. Now there are few points we don't consider we don't consider in the cost of the finished good. That is abnormal wastage if we have any. So abnormal wastage we don't consider. They're like a material label or whatever that here. Storage cost generally we don't consider. Example, the go down rent for storing the finished good, unless production process requires such storage. It means the production process is mandatory for such process. Example, a wooden barrel is it when they do the production of wine, that is the wooden barrel that they have to keep the wine in a wooden barrel. That is the process. That storage is a part of the cost of inventory. Third is the administrative overhead that do not contribute to bring the inventory to their present location and condition. So we incur administrative expense, but administrative expense not for the purpose to bring the asset to their present location condition. Example, sale of accounting department that has nothing to do with the bringing the inventory to their present location and condition. So it will also be not included. Selling and distribution, the cost that like the sales commission. Okay, that is also not a part of the cost of inventory. Now also the D point, that interest in the borrowing cost I will cover in accounting standard 16, that is the borrowing cost. So interest or borrowing cost generally I am saying is not a part of the cost of inventory. I am saying generally, but there is one exception that we are going to cover in accounting standard 16 that year. Okay, but inventory and borrowing cost in general is not a part of cost of inventory. Okay, so the few points now I have covered the introduction, definition of inventory, measurement. Okay, now I'm coming to the point number 4 that here. This is the because we do the comparison cost or NRV, whichever is what lower. So, okay, understand. They say it should be done on item by item, although grouping similar are also allowed, but not on global basis. What does it mean? Suppose in my shop I have 2 items, laptop and television. When I say laptop, so I can compare individually like this. I have 2 companies laptop, two different types of company. So individually it is allowed to do that. Okay, individually it is allowed to. I can compare the cost and no problem. It is also allowed that here. Similar item. I'm a laptop of some different companies. So I can club the cost of all the item, club the NRV of all the laptops, and this grouping similar item is also allowed. But they say like same we can do in case of a television. Individually, I can compare the cost of NRV, or we can group all the television costs, all the television NRV. It is allowed. Same. But you know what is not allowed? I cannot do a grand total of all the cost of all laptop and television. And NRV of all laptop and television, then do the compare. They are not similar item. If you go to shop, if you want to purchase a laptop, if you don't find it a good laptop in shop, then do the shopkeeper tell you, okay, if you don't like it that year, why don't you purchase the television? It is not interchangeable item. Okay. So on the grand total means it is not allowed to do the grand total of all the different item. Okay. Individually it is allowed. Similar item you can group it that here and then you can compare that. Okay. Now The fifth point is special case. What in the case of a joint product? Like you can see the here, this is a company, the put and a lace company. They have a put and they manufacture chips that here. So they say up to a certain stage, it is a joint cost that here. Then different flavors will come. So what about the joint cost? How to allocate these joint costs? They say a split of are allocated on a rational basis. Example, what is sale value? The split of time. Okay, so what is the sale value that here or that you're going to here at this stage that any rational basis which logically is allowed, anything which is rational, it is allowed to do that here. Okay, how much quantity you are using for this particular flavor. So on that, you have to take the quantity by selling price per unit of all the different product that you have manufactured from that common, the joint cost. And on that basis of the sale value, you can allocate the joint cost. Okay. Now, byproduct is that which we don't want to manufacture, but during the process that manufactures, they say usually not a material. Okay. Usually those are joint product and the, the byproduct, not joint product. Byproduct is scrap that here. Byproduct generally we don't want to manufacture, but generally suppose if it happened that here, so because of that byproduct that is which is generally not material, so which we do the valuation at what NRV, and that NRV of the byproduct that have to be deducted from the main product. So they say whatever the they say here what the main product cost that here. Okay, there is the one correction that here now is it not a joint cost minus there is one correction that here. This is the cost of main product, whatever the cost of the main product that here. Okay, whatever the cost of the main product, we are going to deduct from that here what the NRV of the byproduct. Basically, to make it simple, that here now, the total cost of the main product that here now, and what we do that here, whatever the total cost of the main product, the NRV of the byproduct we deduct from the main product cost. That's it. Okay. Now the cost formula. What is this cost formula that here now? Is the cost formula they say that here now is the specific identification that is. So first is that this is the best method. If you know that here now, when we talk about the cost, we don't know how much is the closing stock. Some quantity we know, but from which lot it is in the closing stock. So what is that here now? They say that here now. Here what they say, it is the best way if you know that here, suppose we have purchased a 10 type of lot data. So we know that from which lot the item is in the stock. That is the best way that here. If possible, track exact cost of each item or lot. If not possible, then they say FIFO is allowed. Weighted average is also allowed, but LIFO method is not allowed. The third is the standard price method, in which used for rapidly changing item determining cost of what? The inventory. So they say sale value of the closing stock, sale value of what? The closing stock, minus what we do that here, minus the profit. We are going to find the sale value, basically the sale value of the closing stock minus what is this? I mean to say sale minus the profit, that is cost only. If we are not able to find the cost, we'll take the sale value of the closing stock, we'll reduce the profit component from that, and we'll come to what? The cost of the closing stock. Okay. Now, the last part is the disclosure and classification. In the financial statement, I will disclose the accounting policy which I follow, like the FIFO or weighted method and the weighted average cost formula used for the inventories. Classification, my inventory might be raw material, WIP, finished goods, stock in trade, store and some spare part, loose tools, if they meet the definition of inventory. If they don't meet the definition of these, basically, if these loose tools and spare parts, if they don't meet the definition of PP, then they come under AS2. But don't worry, in AS10, we'll discuss about the what is the definition of PP and when they meet their criteria. Or any other like the damaged goods, if we have to specify we have to do the classification of the inventory. So this is all about the accounting standard 2. I will come to question, but what we have covered, the point number 1, that is the introduction that here. Okay, we have to do the valuation of inventory properly so that we can find it out, the proper valuation of the proper profit, we can find it accurately, and the current asset also, because inventory is a part of what? Current asset. Then the definition of inventory is the finished goods, stock in trade, or WIP, or what? The raw material. Measurement, cost or NRV, whichever is lower. What do you mean by cost? Cost means that here, the cost first we purchase that here at the time of purchase, direct cost incurred, the conversion cost, or any other cost which we have incurred to bring that inventory to their present location and condition. Now, when we talk about NRV, finished good, estimated selling price minus cost to make the sale. WIP, NRV, estimated selling price minus cost to make the sale of finished good, and minus any expense we are going to incur from WIP to finished good stage. Okay, what is the NRV of raw material? Replacement cost. Okay, but one exception, when you talk about when we do the comparison cost on NRV, whichever is lower, remember that here, in case of the raw material that here, if my this table that here, okay, this table, okay, if my NRV is going to be more than the cost, no problem that it will be recorded lower, that is cost. But if my NRV is going to be lower than the cost, one exception, we have to see the finished good that is. If finished good is expected to be going to sell it more than the cost, no problem that here. In that is more than the cost, if it is going to sell the finished good that here, it means there will be no loss in the future. Okay, so even though my NRV is lower, I will record it cost. But if my finished good is also going to sell it lower than the total cost, in that case, I will record it the NRV. This is an important point. Okay, now, because of what? Conservatism approach. Okay, now special formula is allowed, the special case, the joint product that we discussed that here, any rational basis split of point sale value, split the joint cost on that. Okay, the byproduct, what is the NRV of the byproduct, that we have to deduct the cost from the main product. What is the cost formula that here? With the specific identification method, FIFO method allow, weighted average method allow, but LIFO is not allowed. Disclosure we have to do, it is a raw material, WIP, finished goods, stock entry. Okay, like that. So this is all about the concept that we have discussed. Now we will cover the question on what? The question on accounting standard 2. The question number 12. Okay, so it says HP is a leading distributor of petrol. A detailed inventory of petrol in hand is taken when the books are closed at the end of each month. At the end of the month, following information is available. How much sales that are? 47,25,000. General overheads cost 1,25,000. Inventory at beginning 1 lakh liter at rupees 15 per liter. Purchase June 1st 2 lakh liters at the rate of rupees 14.25, and June 30 they have the 1 lakh liters, again they purchase at the rate of 15.15. The closing inventory is a 1.3 lakhs that here. Okay, liters. Now compute the following by the FIFO as per AS2. What the value of the inventory? Okay, then this amount of cost of goods sold and the profit or loss. Very simple is that here. Understand this one. I will come to value that here. But when we talk about the cost of goods sold, how we calculate the cost of goods sold? Opening stock, what we write it? Opening stock plus purchase. Okay, opening stock plus purchase minus closing stock. How we calculate the profit? The profit we calculate sales minus COGS, means cost of goods sold, minus indirect expenses. Okay. So one by one, let's first calculate. I will come to value of inventory, because when I calculate the COGS that in point number 2, we have to calculate closing stock also. I will come to that. But the first thing is that is the opening stock. Let me write one by one. So opening stock, how much there? 1 lakh liters, 15 rupees. So 1 lakh here quantity multiply by 15, 15 lakh. Then I will do the purchases. So purchases, how much we have? 2 lakh liter, 14.25, 1 lakh liter, 15.15. So 2 lakh multiply by 14.25, that will come 28 lakh 50,000. Okay. And here 1 lakh liter 15.15. 1 lakh liter multiply by 15.15. This much amount will come. The total. Now, what I have to deduct? The closing stock. Please understand. Initially, I have opening, then I purchase 2 lakh, then I purchase 1 lakh. So total 4 lakh. Opening 1 lakh liter, then I purchase 2 lakh, and then 1 lakh. Total 4 lakh. Okay. But out of 4 lakh that here, out of 4 lakh, how much is in the closing stock? It is mentioned that here, that is 1 lakh 30,000 is in closing stock that here. Okay. So they say we have to follow the FIFO method. Apply your logic now. Is it that here now when we talk about this closing stock that here, so initially opening I have 1 lakh. Opening I have 1 lakh. Then I purchase that how much here? The 2 lakhs here. Then I purchase how much? 1 lakh. This is stock. Oh, total purchase and opening stock. But in my closing stock, how much I have? 1 lakh 30. So this 1 lakh 30, out of this is 1 lakh here, and out of this how much? 30,000 that here, because we follow which method? We follow FIFO method. Okay, the first thing first out that here. So this closing stock 1 lakh 30, from this 1 lakh complete is in closing stock, and from these 2 lakh only 30,000. At what price we purchased these 2 lakh? Per liter was 14.25. So 30 multiplied by 14.25, and here the 1 lakh, what is the price per liter? 15. So 1 lakh multiplied by 15.15. So you can see that here 1 lakh multiplied by 15.15, 30,000 multiplied by 14.25. This is the value we have. So what is the formula that here now? Opening plus purchase minus closing stock. So now we'll reduce the closing stock. So we come to cost of goods sold. So we have also find it out the cost of goods sold as well as the closing stock. Two things done. Now they say the profit. So sales. What is the value of the sales that here now? Now sales is this 47 lakh 25,000. So 47 lakh 25,000 minus, what is the formula? COGS, minus COGS that we have calculated earlier here, minus indirect expenses, they have overheads given 1,25,000. This is the profit of the company. Simple. Now, very interesting point again, the raw material point is coming. Listen carefully, it is not at all difficult. Just you have to listen me carefully. Okay. Now it says that here, A limited is engaged in manufacturing of chemical Y for which raw material, the raw material X and the Y is the finished goods, okay, is required. The company provides the following information for the year ended 31st March 2017. The information about the raw material, information about the finished goods Y. Very simple. How is the valuation? Cost or NRV, whichever is lower. Okay, just you have to listen me carefully. So what is the cost? Is the cost price is 380, unloading charge is 20, freight inward 40. Replacement cost is NRV. So here for the raw material, how much is the cost of raw material? If you do the total 380 plus 20 plus 40, that will come 440. Replacement cost is NRV. How much is NRV of raw material is coming? How much here? Is it 300? Now you say, okay, sir, NRV is lower than the cost. So we will do the valuation as NRV. I say, wait, we have to do the closing stock or these the finished goods cost for NRV as well. So then they say, these finished goods, material consumed 440, direct labor 120, and variable overhead how much? 80. Additional information. Now, total fixed overhead for the year was rupees 4 lakh. Normal capacity given. So one more thing will come here, fixed overheads. Okay, that is a 4 lakh is the total amount divided by normal capacity. They have not given something for the actual and comparison. So just 4 lakh. I say gives so simple. Okay. 4 lakh divided by 20,000. That will come at 20. So this will be the total cost here. How much is the total cost? 440 plus 120 plus 80 plus 20. So this is the total cost. Very simple. Yes. This is the total cost. How much is the cost of finished goods? 660. Now we have to write it on the NRV. Then we can find it out. So simple. Then they say closing stock of raw material, we have 1000 is in the closing stock. When I talk about the raw material, okay, two situations are given, 1 or 2. So let me write like that, 1 and 2. Raw material, how we do the valuation of raw material and finished goods. Here also raw material and finished goods. So we'll decide that here. But how much we have in the stock of the raw material? We have 1000 units. So 1000. Okay, multiply. Then here chemical, the finished goods 2400, 2400. Two situation given. That's why I have written 2 times. Okay. Now how to decide here their value, cost or NRV, one by one. In first the case they say NRV of the chemical Y is 800. Very simple that here. I am saying here, listen carefully. If I say that here now, okay, if I say that here now is the raw material. Listen carefully. What is the cost of the raw material? 440. So I say that the cost is 440. How much is the NRV? NRV is here the 300. So don't say just take the lower. Just we have to see the finished goods position. I go to finished goods. What is their cost? We have calculated 660. What is their NRV given in the first situation? 800. NRV is given 800. Now again go to this slide. Now these notes, what they say is that now, if NRV of the NRV of raw material is lower than the cost, yes, my NRV is lower than the cost of raw material. Okay, then we have to see if finished goods are expected to be sold at or more than the cost. Yes, my finished good is expected to be sold at 800, which is more than their cost. So here valuation should be done at what? Cost. I will do the valuation at what? Cost. Logic is that here now, because my finished good is going to recover the loss, even though the NRV of the raw material is lower, but the finished goods will recover the loss. Ultimately, there will be no loss when finished goods sell the product. So even though NRV is lower, then still I will do the valuation at cost, because in future there is no loss. Conservatism approach does not apply therefore here. Okay, so does not apply means this is a violation of the conservatism approach. So I will do the cost here, and here cost or NRV, whichever is lower. This is, so I will do in first situation, I will multiply by 440 and 660. See how simple it is. It comes for 7 marks in examination. Advanced accounting is the most, it is the easiest subject you have in C-Inter, and to score 80 plus is very easy. Just you have to proper approach. Through these revision series only, I assure you that here, if you follow my instruction, you can easily score 60 plus. Just listen me carefully. Okay. Now second situation. Okay. Now come to Second situation, what it says that here. Okay. Now again, I am writing that here. Now let me change the color that here. Okay. Now if I say that here, same raw material, finished goods. Okay. The cost is how much? 440. NRV is how much? 300. Finished goods cost is same 660. When it's come to NRV, they have mentioned here how much here? 600 seat. How much they have mentioned is 600. So I will write it down 600. So what happens when we do the comparison, the cost for NRV whichever is lower. So we will say NRV is lower. Correct? NRV is lower. Correct that here. But we have to see that. Don't just write NRV here. Now see the situation. If finished goods are expected to be sold at lower than the cost, it means my finished goods is also not able to recover the loss. So you can see that the cost is 660. I'm selling less than 660, 600 only. So my finished goods is not able to recover the cost, that is also at the loss. So at what price I have to do the valuation? NRV only here. So I will do NRV lower, yes. Lower we have to do because of the conservatism approach, because in future also finished goods not able to recover the loss. Say the cost is 660 NRV. So we do the valuation at what price here? 300, and here how much is 600. Simple, done. 7 marks is yours. Okay, like that they have done that here. Okay, they have done the calculation here. First case 1000 multiplied 440, this 660, correct. Second here 300 and 600. Okay, and I will tell you separate video I will make how to write answers in exam. Very smart but easy way. I will tell you separate video I will make how to write accounting standard question in examination. Okay, now here last question. Now come to the question number the 14 that here. What it says that here? It says that here now Mr. Mehul gives the following information relating to items forming part of inventory as on 31st of March 2015. This factory produces product X using raw material A. It means different types of product. So 600 units of raw material. The first point talking about what? Raw material. They have 600 units. Okay, 600 units of raw material. Purchase raw material A purchase at 120. How much is the cost? Come on. What is the cost? Raw material we are talking about. Just give me a minute. Let me write here. Okay, because of space, let me write here. Okay, so raw material and here finished goods I will write. How much is the cost that they have mentioned? 120. Okay, then they say the replacement cost of the raw material A and 31st March 2015 is rupees 90. So what is the NRV here? Is 90. You say, oh, lower is 90. So you say, wait. Don't just say lower is 90. Okay. So I mean to say we have to do here we have to go to finished goods. The point number 2 say 50 units of partially finished goods. Partially means what? WIP. So I will discuss about them later on. Let's come to the third point. 1500 units of finished goods. This is the finished goods. I will come to WIP. Don't worry. But they say finished goods X and total cost 320. Their cost of finished goods is 320. And expected selling price of the product is 300. So NRV is 300. Now listen carefully. What is going to happen here in case of a raw material? When I compare cost and NRV, whichever is lower is NRV. Then I go, the NRV is low. Then I go here. If finished goods are expected to be sold at lower than the cost, yes. The NRV of the finished goods is 300, which is lower than the cost. So we have to do the valuation at what here? NRV. So I will write it down NRV only because of the conservatism approach, and also my finished goods is not able to recover the loss. In case of finished goods, cost and NRV whichever is lower, NRV is lower. So finished goods I will do, if I write it down here, raw material, WIP, finished goods. So raw material, how much is the quantity I have? 600. The valuation will be at what price? 90. I will multiply by 90. Here finished goods, how much quantity I have? 1500. Finished goods, how much quantity I have? 1500. Okay. Multiply by, if I say how much is 300. Okay, 300. Simple. Okay. Now, second point, WIP. They say how many? It's 500 units of partially finished goods. So 500. Multiply by. In the process of producing X, I tell you what here. In case of the partially or WIP, I told you that here. What I told you that here, in case of a WIP, cost. Okay. Cost they will give us, but when it's from the NRV, first take the NRV of the finished goods minus any cost that we have incurred from WIP to finished goods stage. So they say that here now 500 units of partly finished goods in the process of producing X. Okay, and cost incurred till date is 260. What is the cost here? The cost is 260. I will take NRV. NRV cost is 260. Okay, and these units can be finished next year by incurring additional cost of 60. So how we calculate NRV here? So we have to take the NRV of finished goods. How much is the NRV of finished goods? Is 300. So I will take 300 minus what is the cost that will incurred from WIP to finished goods stage? 60. So I will minus 60. 240 is NRV. So 260 is cost, 240 is NRV. The lower is what? 240. So I will multiply by what? 240. Now you got what? 7 marks. People call it, oh, so difficult, sir. Not at all. So 600 multiplied by 90. That is coming how much? 54,000. Then here 500 multiplied by 240. 1,20,000. And the 1,500 multiplied by 300. That is coming how much here? 4,50,000. If we do total, that is coming 6,24,000. Correct? Done. Okay, so now we have done accounting standard 2E, accounting standard 2 completed here. Okay, so this is so simple. Don't worry that here. Now I will come one by one with all the accounting standard. Like that, we are going to cover all the years along with these important questions that here. That is definitely is going to help you. And if you like this video that here, or if you want to tell me anything, just drop your message in comment section. I will give you reply there. And that's for today. Take care of you. Just one last thing that here. Okay, let me tell you honestly that here, CA Intermediate Advanced Accounting is not at all difficult. Its syllabus is vast, but it is not at all difficult. Okay, and you have caliber that easily you can score, easily you can get exemption through this revision series. Easily you can get exemption. Just you have to listen me, and you have so much of potential you have that here. Okay, so don't underestimate yourself that here. You can do miracle that here, but be confident that here. And just focus on your study. If you want to say anything to me, just drop any message in comment section. I will give reply there. So that is for today. Take care all of you. Bye-bye.